Ladies and gentlemen, good day and welcome to the Ikio Lighting Limited Q2 and H1 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar Investor Relation Advisors. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us today. We have with us today the senior management team of Ikio Lighting Limited, Mr. Hardeep Singh, Chairman and Managing Director, Mr. Sanjeev Singh, Whole-Time Director, and Mr. Atul Kumar Jain, Chief Financial Officer, who will represent Ikio Lighting Limited on the call. The management will be sharing the key operating and financial highlights for the quarter and half year ended September 30, 2024, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon our beliefs, opinions, and expectations as of today. These statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. Now hand over the conference to Mr. Hardeep Singh. Thank you, and over to you, sir.
Yeah, thank you. Thank you all of you for joining on the Q2 and the H1 FY25 earnings call. Our presentation has been uploaded on Stock Exchange, and I hope you all have a chance to look at it. We are happy to mention that overall traction continues with revenue growth of 11% on year-on-year to 252 crores in H1 FY25. This was an account of all three business verticals we are doing. Coming to Q2 FY25 highlights, the revenue was up 6% year-on-year and marginally down by 2% Q1Q. The Q1Q impact is on account of changes product categories in ODM segment, as some of the old SKUs are being phased out and new SKUs are being introduced. We expect the sales to pick up in the coming quarter. The continued growth Q1Q and Y-on-Y in product display segment. Also, we have started supplying to Gulf region, where we have forayed in Q1 FY25. The energy solution and other segments, we witnessed double-digit growth Q1Q, Y-on-Y, as inventory clearance continued gradually in our RV products in USA. Coming to profitability, we are happy to report that in Q2 FY25, our gross margins improved to almost 43% due to favorable product mix and operation stabilizing at the USA subsidiary. Our EBITDA margin was at 18% improved Q1Q in line with expectations, as the revenue from the new facility and product categories added operating leverage. Year-on-year negative impact is on account of front-loading expense like higher employees costs led by team expansion for new facilities and new product categories. PAT grew 4% Q1Q to rupees 13 crores in Q2 FY25. However, growth impacted due to higher depreciation on account of commercialization of new facility. Block 1 of the Greenfield project effective May 2024, and reason mentioned earlier for the EBITDA decline. Now I will request Mr. Sanjeev Singh to provide his thoughts on the quarter. Over to you, Mr. Sanjeev.
Thank you. Let me now take you through key business initiatives undertaken to boost growth further and give some more insights about how things are progressing. As you know, we have successfully commercialized Block 1 of 2 lakh square feet in May 2024. This is just one part of our overall greenfield expansion project of 5 lakh square feet. Block 2 of another 2 lakh square feet is expected to be completed by March 2025. As of now, we are undertaking the civil construction. As we mentioned in the previous call, we are expanding our product basket and have forayed into the hearables and wearables. I am happy to inform you that the company has got orders and onboarded 7 to 8 top brands in the domestic market. We would like to highlight that we are expanding our global footprint. In the USA, in addition to the RV business, we have started supplying our industrial and solar products to energy services companies. Also forayed into the Gulf market for the export of our products under the product display segment. As a result of an effort to diversify our revenue streams, the contribution stands at 20% in the first half of FY25. To conclude from my side, we believe it is imperative that we take these steps in new markets to help us diversify our revenue streams, both product-wise as well as geography-wise. We are looking forward to exciting times ahead, as our new initiatives will start bearing fruits in the long run. With this, I conclude my remarks on our strategy for the way forward. I now request Mr. Atul to please go through the key financials.
Thank you. Let me now take you through our financial performance and the utilization of our IPO proceeds. Our financial position continued to remain strong with a net debt-free balance sheet and well-funded capex cycle. As mentioned earlier by Hardeep sir, our growth trajectory continue in H1 financial year 25. We witnessed a revenue growth of 11% year-on-year to rupees 252 crore, and the gross margin remained largely stable at 39%. The EBITDA stood at rupees 39 crore in H1 financial year 25 versus 50 crore in H1 financial year 24, and PAT stood at 25 crore in H1 financial year 25 versus 32 crore in H1 financial year 24. In Q2 financial year 25, our consolidated revenue up by 6% year-on-year and down marginally by 2% quarter-on-quarter at rupees 125 crore. The EBITDA margin was at 18%, improved by 460 basis points Q&Q in line with expectations, as revenue generation from the new facility and product categories added operating leverages. It is down by 490 basis points year-on-year, as the impact is on account of front loading of growth expenses like higher employee costs led by team expansion for the new facility and new product categories. PAT stood at 13 crore, up 4% quarter-on-quarter and down by 29% year-on-year. The growth was affected due to high depreciation on account of commercialization of new facility Block 1 of the Greenfield project effective May 24, and the reasons mentioned earlier for the EBITDA decline. On the IPO proceeds, the repayment of debt was completed immediately after the IPO. Block 1 is now operational. For Block 2, civil construction is ongoing and completion is expected by March 25. We are now deployed around 60% of the IPO fund and are on the course to complete deploying the rest within the timeline we set for ourselves. That's all we have from the company side. I request the moderator to please open the forum for questions.
Thank you so much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. An operator will take your name and announce your turn in the question queue. Participants are requested to only use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mayuresh M., who is an individual investor. Please go ahead.
Good afternoon. Am I audible?
Yes. Yes.
Yes, first of all, congratulations for the opening of our new facility. It will certainly give us a boost in the manufacturing process of the new products there that we are going to, look forward. For me, I am more interested in the energy solutions category that we have. For example, the solar panels, the rotary switches, the lithium battery. I would like to know what is the current revenue share of this category of energy solutions, and what is the revenue share that we are looking forward in the coming 2 or 3 years. And also, I see it's the solar panels for RVs. Are we also looking forward to create a production unit for solar panels, like in general, like in a large amount?
So first of all, I'll start from the backward, because for energy side, solar panels we are making right now. We are making basically for irrigation vehicles, RVs, and the market is growing like on month, it is giving good response. And next year, because in USA the year starts from Jan to December, so this year we are doing good, and we understand the market very well over there, and we are getting the repeated orders, as well as we are adding the new customers. So that segment is going very well. Your second question about going into the energy sector for solar. For domestic sector, we are not looking at that at all, but we are looking at USA market, where the complete project is there, not only the solar, where there are ESCO projects, which are only energy solutions that include the solar, lighting, etc. So we are the company is getting the orders for them, and that revenue is also like quarter-on-quarter basis it is increasing. So this is the thing for the energy section. Any other question?
So we are not looking forward to manufacture solar panels for creating big solar projects domestically or in the US. It's specialized solar panels used for lighting.
No, we are not manufacturing the solar panels. We are getting it done with our specifications and all from other vendors, and giving to the projects in USA.
All right, understood. And how about the lithium battery?
Lithium battery we are using for ourselves, but lithium battery, because of so many constraints, it is little down, but we are now, we have started the hearable and wearables. It also consumes a lot of batteries, so we are planning to have those aligned lithium batteries.
Yes, understood. Thank you. And any projections on the revenue share from the energy solutions in the coming 2 or 3 years?
So for the energy solutions, basically right now the way we have divided or we are presenting the business is through 3 categories. So one of the categories, energy solution and others. So basically it comprises of the business that we are doing in the US, that comprises of the RP business, the energy solution business, and also the business that we are doing in the export market. So as you might have noticed, that revenue share is also going up. Like last year it was somewhere close to 15% of the overall business that we did, and this year in first half itself it has contributed to 20% of the overall revenue. So that share is increasing, and because we are very new in that energy services business, the business that we are doing with the ESCOs that we are doing there in the US market, it holds huge potential, and we are working on those lines, and we are what Mr. Hardeep also mentioned, it is not just the solar panel or just a lighting product. It's a package where we are supplying a mix of a lot of products, and that depends on project to project basis what the requirement is. So that is why we have 2 streams of catering to that market. One is the direct export that we are doing from the Indian market, and the second is the subsidiary that we have created in the US, so directly from that subsidiary also.
Thank you very much for the clarification. Appreciate your answers and time. Thank you very much and good luck.
Thank you so much. Thank you, Mr. Mahesh.
Thank you very much. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. I repeat, you may press star and 1 to ask a question. The next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Hi. Sir, thank you for the opportunity. Sir, I have a question on our margin sustainability. Sir, when I look at our margins, sir, I went through the previous con call and sir, I understand that we provide some R&D as well as we are backward integrated. That's why our margins are better. But sir, when I look at branded lighting players, branded OEMs, so their margins are, most of the margins are in single digits. And sir, so that's what I'm trying to understand, sir. Can we face a pressure from OEMs going forward whereby it would lead to our margin compression? As well as the second question would be, sir, we are increasing our scale in the lighting business with Philips Block 1. So will there be another instance of a margin pressure as scale increases? Because we were doing only niche products till now, and going forward, as we focus on filling up our capacity, there could be some kind of margin pressure going forward.
So hi, Mr. Madhur. Thank you for, the couple of questions that you asked. The first one related to the margin compression. If you're closely following, the results and the quarterly investor calls, then the margin compression right now, is happening on account of basically the onboarding of the front loading of expenses that we are doing for the new verticals and the new product lines. So the new plant that has also come up, it is yet to give the desired results, or basically the production is yet to start in that in that scale. So it will take some time. I hope you understand that creating a facility and then bringing in business, it's a process that takes a lot of approvals from the customer end as well. So we are in discussion with a lot of new customers also. Some of them in very advanced stages where we are talking of product approvals and all of that. So the margin compression, like I said, is largely due to the front loading of expenses that we are doing and on account of the depreciation as well because of the new facilities that we have created. So once all these new plants, machines, they start generating the revenue, so automatically the margins will start improving. And if you compare the margins from Q1 to Q2, there is anyways there is an improvement in the EBITDA margin from Q1 to Q2. And going forward, the new verticals that we have started, like in in the US market, or if I talk of the wearable. So to begin with, we are doing right now OEM business, but our plans is to go ODM. Like I've been we've been talking about this since past quarter or two. So we are on that path. We are developing a lot of things in-house. So, but it will eventually take some time, but another few quarters, and you will start seeing those results as well. And your second part of the question that was related to the Block 1, increasing the sale, and again the doubt on margin for the Block 1. So basically in Block 1, if you look at the presentation also, we will be doing the lighting products that we are already doing, but apart from lighting, we are also diversifying in that unit, and that is very much I would say evident from the type of infrastructure that we have created. So the SMT lines, the machinery that we have installed, that is not only for the lighting industry, but it is capable of handling a lot of other electronics that we intend to manufacture in the near future, for which we already are taking a lot of action. So going forward, we will keep updating our trajectory and also the performance that is happening. And but right now, we are in line with what we've been talking of in terms of the revenue and the margins, and we'll keep you posted on that.
Okay. So my question was on a longer term basis. So, sir, my question was basically, sir, when I look at branded lighting distribution companies or FMEG companies, so their margins are similar in the single digit or at much low double digit. But whereas we are making 20% kind of margin, so I'm trying to understand, is this margin sustainable? And sir, why would the OEMs not kind of pressure us to reduce our margins going forward? So on to those front, and sir, so why are our margins better? But sir, can you explain it in? Can you clarify regarding this?
So basically, if I think you looking at the margins, consolidated margins, but if you look at the standalone margins, our margins are in standalone figures. Our margins are on the lower side only, and that is again because being an ODM business. But still, because it is ODM and we are manufacturing everything in-house, the margins are still decent, but on the lower side. But if you look at the consolidated numbers, the margins are better because it involves a lot of other activities, other product lines that we are doing, where in certain verticals the margins are slightly better, and in certain verticals because we are doing everything in-house, and though the margins of the backward integration that we are doing are also getting added in the consolidated revenue. So it is that effect that you are seeing in the consolidated numbers. And just because although I have discussed this in the previous calls as well, but I'll just reiterate, if you look at our numbers, if you look at our history, maybe 6 years before or, around that time when we were not doing a lot of backward integration, so our margins were lower on the lower side only. It is only after the backward integration that we started doing from 2017-18. That is when the margins started improving, and it is a result of that only.
Okay. So your standalone business is pure play the lighting ODM part, and sir, what would be the consolidated numbers other than the RV business where the margins are higher?
Sorry?
So on the standalone business, I would expect that it will pure play the lighting ODM or the lighting EMS part of that. But when I look at consolidated, so what all business would be added where the margins are higher?
So like I said, right now we are presenting a business in 3 categories, although there are more verticals to that. But we are presenting in 3 categories just to simplify for the investors. One is the ODM business, second is the product display, and third is the energy solution and others. So basically in the ODM, we talk of only the lighting that we are doing in the ODM category, the high-end home decorative lighting. And when I talk of the product display segment, in that there are 3 categories within the product display segment as of now. That is the store lighting that we are doing, and the refrigeration lighting, and as well as the wearable that we have recently added. And in energy saving and others, it's basically referring to the business that we are doing in the US and the business that we are doing in the Gulf, and the production that is, the products that are being exported to these markets. So this is how we've bifurcated, the categories as of now. You were asking about bifurcation only, right?
Yes. So apart from the ODM business, everything is under a consolidated entity, under a subsidiary, basically. Is that understanding right? Correct. Okay. And this is the final question, and then I'll get back in the queue. Sir, we are guided for a 20-25% revenue growth and a 20-20% kind of margin.
Your voice is a bit muffled, so it's not very clear.
Sorry, sir. Sir, is it better right now?
Slightly better, yeah.
Yeah. So I'm just asking about the guidance that we had given. Sir, can we expect that guidance to follow through, or there would be some pressure in following that guidance of 20-25% growth and the margin guidance?
So right now we are in line with the guidance that we had provided, and because by this this quarter and the next quarter, the quarter where we are right now, this and the next quarter, we have planned to introduce certain new products. Even the hearables and wearables, will start kicking in the the revenue, decent revenue in the revenue mix. So we are in line with what we had projected, and if there will be any sort of maybe clarity that needs to be given, I think in the third quarter we will give you that clarity if there will be any. But right now we feel we are exactly on track to what we had projected for the financial year.
Sir, on the margin front as well.
Sorry?
Sir, on the margin front as well, because I understand that the hearables and wearables would be a lower margin because of the OEM kind of starting in this business.
Yeah, so right now, like I said, it's the OEM strategy that we are following, and the ODM strategy, because it's under development. We are developing the tools, molds, and all these for the products that we will be doing from scratch. So they will probably start kicking in from the fourth quarter, and then eventually from the next financial year. So revenue-wise, we are in line with what we had projected. And in terms of margin guidance also, we have maybe a lower, close to around 20% figure is what we are expecting by the end of the financial year.
Sir, that makes sense. So thank you so much and all the best.
Thank you so much, Mr. Madhu.
Thank you very much. The next question is from the line of Karan Gupta from Rely Investment. Please go ahead.
Hello, sir. I had a few questions. I just to understand the company better. Sir, can you just probably share some of your unlisted space competitors who are maybe your peers in what you're trying to do? I remember you have told previously that there is no exact competitor, but could you just kind of throw some light on whom you feel would be your right competitors? Second question is, sir, you have a ODM relationship with Signify, and if I understand correct, Signify has mentioned 20% growth vis-a-vis 10% growth in the segment. So given the fact that they are pretty much bullish on the India business, so how do you see that percolating to your business visibility? Because that I understand is a more forecastable business based on your visibility provided by Signify. And one final question before I join further in the queue, sir. Could you just provide some thought on how you are able to kind of price? So is it affected by any kind of China-based dumping on LEDs or things like that? So on your basically your ODM part, which is your more growing part, ODM and OEM. So these questions first, and I'll follow.
Yeah. Hi, Mr. Karan. So basically, the first part of your question, I think, was related to the unlisted competitors. Yeah.
Listed or unlisted? I mean.
Yeah, it's actually very difficult for me to name, any competitor as such, because like we are in multiple verticals and multiple streams. So honestly, I cannot think of a single name where I can, give you any idea related to who is our unlisted competitor, because in each category maybe we have someone as a regional player or something of that sort. So I'm really sorry. We never looked up. We have never looked up that kind of information. So I won't be able to give you any name as such. And I think the second part of your question was related to the Signify business that we are doing. So the growth that you had mentioned. So I'm not sure. Actually, I have not gone through the numbers of what growth have they reported. But actually, in lighting also there are multiple verticals within the lighting segment also, and we are in the high-end home decorative lighting space, which is also called the functional decorative lighting. So I am not sure what is the number that they have reported in that category. But what I can tell you about our degrowth in this quarter for the ODM business, that is largely due to the fact of some of the existing products getting phased out. So sometimes, it takes a while for us to get that information related to the demand that is there in the market, and because it's a long cycle, so it takes maybe a couple of quarters for us to understand and adjust our products accordingly. So this happens once in every 2 years, that something like this, because of the long list of SKUs that we have, and we've already started working on the new product categories to sort of bring into the market to replace the existing ones, and we are also talking to some new customers. I cannot name them right now, but they have visited the facility, and with some of them we are in the advanced stages of discussion. So maybe a couple of quarters more and we will be able to throw more light on this aspect as well. And I think the third part of your question was related to the pricing for the ODM segment, if I'm correct.
Yes, sir, the general LED-based lightings and general where you are more dependent on the market rather than your exclusivity.
So actually, in the pricing of the ODM segment, I would call them, it's not more dependent to the market. It is just that, the products that we try and bring for the ODM segment, it's not the generic products that are there in the market, and that is why we are there in that niche high-end home decorative lighting space. And the pricing we do is, it differs from product to product, but we do have a set costing method, that is approved by our customers, and basis on the raw material pricing and everything, we are constantly evolving the pricing of our products as well. So it's a simple system where we have a set cost plus method which we follow for our ODM products.
Right. And sir, can you just throw some of the very strong tailwinds, because your other ODMs maybe not of exactly your business, but maybe similar business in electronics and lighting manufacturing. So they are kind of saying that 5 years back they were not so bullish, and right now, and you are already on your capex mode. So how do you kind of see the general bullishness, including the US markets, on a consolidated basis, or which segments do you per se see that you are seeing, a lot of growth which was not seen historically? We have been in the same line for many, many years. So could you just throw some light there?
So actually, our ODM business has generally been doing, well, if you look at the past few years. And apart from that, it's growing at its own pace. But apart from that, the newer verticals or, the other segments like the product display category and the export market, this is where we see most of, the growth coming in the near future. And obviously the new the areas where we are working, because it's very difficult to, make you understand without naming a few things which I cannot do right now, but we are working on those directions. So the new categories, especially the export market, we are very bullish in the export market, the new avenue where we have started working in for the ESCOs. So that is one area, plus the geographical expansion that we are doing. So there are a lot of things that are, happening in the back end. And along with that, the capacity expansion, the new plant. So we are in that phase where we have created the facility and we have initiated the discussions. It is just a matter of time where the capacities will start, filling in. So these new verticals and even the existing ones, apart from, let's say, the ODM, we are expecting good growth in these categories.
Right. So I'll follow back in the queue and allow more participants to ask their questions.
Sure. Thank you so much.
Thank you very much. The next question is from the line of Madhur Rathi from Countercyclical Investments. Please go ahead.
Hi, sir. So thank you for the opportunity once again. Sir, if I just do a back of the envelope calculation,
maybe request you to please use handset mode while asking a question.
Is my audio better right now?
No, your voice is...
It's quite muffled, sir. Please maybe request you to use your handset mode.
Yeah, I'm just using handset mode only. Is it better right now?
Slightly better,
But not really. It's very muffled.
Maybe if you could speak a little louder, it will help.
Yes, sir, I'll do that. Sir, if I look at our consolidated minus the standalone numbers, sir, the margins are for the past 2 years are in the 30-33% range. Sir, so I'm just trying to understand, I think as this business will grow, our margins will improve further going forward. Sir, so what is that we do that we earn such high margin in this business? And sir, just forward looking, like where is this business? How are we different from other players? Because I think China would be another competitor and provider to most of these countries in the export market, sir. So on that front.
I will try to answer your question because I got your question part. So correct me if I'm wrong somewhere. So I think you were asking about the margins largely comparing to probably last year to this year, and the second part of your question was related to China being our competition and how we are unique in that matter. Am I correct?
Yes, sir. So the second question, I'll just repeat my first question. Sir, the first question was, sir, if I just remove the standalone numbers from the consolidated numbers, our margins are in the 30-33% range for the past 2 years. So I'm trying to understand what is that we do exactly that we are earning such a high margin, because sir, I don't have a fairly good understanding regarding the company, so that would help very much.
So I think I heard you said if we remove the standalone margin, then our margins are in the range of 30-33%.
Yes, sir. That's right.
I will have to check. I don't think that. So the difference is going to be probably 2 to 3% only, because the ODM business is somewhere close to around 40-45% of the overall revenue share that we have. So even if I remove that, I think the effect is going to be maybe 2 or 3% higher than the consolidated number.
Oh, okay.
Yeah.
Okay, sir. Oh, and sir, on the China front?
Sorry?
On the China front, on the Chinese competition.
So China front, basically China being our competitor and how we are different to them, right?
Yes, sir.
Yeah. So there are a number of factors which probably highlight the USPs that we carry as compared to China being our competitor. First and foremost, I've spoken about this in previous calls as well, that if you go to China and if you look at the one of the
Ladies and gentlemen, line to the management has been dropped, so please stay connected while we reconnect. Ladies and gentlemen, the line to the management has been reconnected.
So should we continue from where we left?
Yes, sir. Please continue.
So I was actually answering Mr. Madhur's question related to that comparison with China. So I'll continue with that. I hope he's on line.
Yes, sir.
Yes, sir. We have them online.
All right. So if you compare us to China, I was mentioning about the USPs that we carry as compared to China. Most importantly, the reason why we started doing backward integration and everything in-house was to bring in the quality control to the products that we are manufacturing. And if you compare to China, if you go to China and look at a factory doing similar kind of business like what we are doing, so basically they would be not doing the kind of backward integration that we are into. That is because of the already available infrastructure in China that they have. So there are factories, if a factory is manufacturing drivers, so they will be manufacturing drivers only. And if there's a factory manufacturing fixtures or is into powder coating, so they will be doing that only. So it's because of the infrastructure that is already available, but that is not the case in India. And because of that, we went into that direction because of the necessity in order to control the quality and in order to grow the number of SKUs that we are doing. So we are doing more than 1,000 plus, SKUs today. And that is not possible if we sort of import from China. So there are two aspects of this comparison. One is if we bring in the products from China, and one is if we are competing with the Chinese players. So if we are competing with them, then we have a much better quality control, much better, I would say, production control, because we are just buying plastic, metal and electronic components and then converting them into the finished products. And in this way, we are able to better service our customers with better lead times and a much better control over the quality of the product. Plus, we, starting from the designing phase of the product, whether it is the aesthetic design or the electronic design, we don't really have to depend on a third party for that. So these are very strong advantages that we carry, and hence, these are the reasons why we are able to get into these new niche verticals, which require a lot of development and planning.
Okay. So just a final question from my side. Sir, why are you getting into the watches and audio equipment space? Because, sir, lighting is such a big category, and I think we can grow much higher and faster in this space, doing niche applications that we are doing right now for the exports market. So why are we moving into a new territory altogether when we can grow our main business only many folds from this stage?
So here also I will try to test, because this also feels related to what we are doing. Because the integration what we have created is not only lighting, it is for like and somewhere. So here also, because Indian market is dependent on only China. So because we have quite a lot previous experience in this field in audio. So because we were making DVD players and home theater systems and all. So this is a similar market, and the volumes are huge. And and found the.
Sir, sorry to interrupt you, but we are getting a disturbance from your line.
From us?
Yes, sir.
I can hear you very clearly.
So now it's better.
Other end, because our room is very quiet as of now.
Okay, sir. So now I can hear you clearly.
Okay.
Yes, sir.
Because we are into electronics and hardware, so this is a part of that. So that is why we are entered into this, and it is completely new team and new vertical. But we know the product and the market. That is why we entered into this. And it is again like in the drivers we are making for the lighting. It is the power supply for the amplifiers. So it is similar, same housing, plastic injection molding, maybe the shoes and some aesthetics. So there is nothing what we are doing for lighting. We have to create something new. We have all the info what is required for those products.
Okay. But sir, I understand that the process is similar and the capabilities of manufacturing products are similar. But my question was, why not scale the lighting? So where do we see our lighting business as a percentage of overall revenue over the next 3 to 5 years? And where do we see these new businesses going forward over the next 3 to 5 years? So that is my final question. Thank you so much.
Like we entered to solar. Solar is also not the lighting, but we entered into solar because it has a charge controllers and also charge controller again is the injection molding, designing, electronics. Same with the refrigeration electronics. It is the same vertical. We have not added any new infrastructure for that market. Only the team leader is from the industry. So he's managing the team, and we are seeing very good growth in this segment. We can foresee very good growth in this.
So actually, just a question of, we better utilizing our capabilities. We have that capability, and if you look at, our company historically, last 20, 30 years of, what we've been doing. Lighting is something that we started 14, 15 years back, but previously to that, we were, into electronics only. So that is our core strength. Understanding of the electronics is our core strength. And we've been doing electronics, injection molding, sheet metal work, and all these things for many, many years now. So obviously we are expanding our lighting business. That is why geographically also we are, going beyond our boundaries now, Gulf being one example for the lighting products and US for lighting and other products. But at the same time, understanding our capabilities and, better utilizing those capabilities and to diversify the business further to bring in more revenues. That is the whole idea. And we are not trying to reinvent the wheel or do something completely out of our, knowledge base or understanding. It is just a better utilization of our knowledge, our capabilities, and the infrastructure that we have created.
And also in the lighting also, we are not we are now making very high, developing very high-end lighting with all the smart controls and all. Lighting is our core area, so we are focusing lighting as well. It is not we are defocused or we are doing. Lighting is a separate thing, and this is vertical. We can see that we can develop this vertical along with the lighting.
Okay, sir. So thank you so much.
Thank you.
Thank you, Mr. Madhur.
Thank you very much. The next question is from the line of Sanjay Sood, who is an individual investor. Please go ahead.
Thank you for giving me this opportunity. I have a couple of questions. My first question is, I was browsing through and I could come across a website, ikioworld.com in US. Does this company belong to you? Because website is similar. It's just out of query I'm asking.
It is not same. That is a different company altogether. Nothing related. Nothing to do with us. They are one of our customers.
They are your customers, okay? Because website and color combination, everything looks to be same.
Maybe they like our idea.
Yes. Okay. And the second question is, you have which brands you are supplying with smartwatches and wearables and wearables?
All type 4-5 brands. We are in touch with them. All 4-5 top brands, and we have NDAs with them, so we cannot disclose the name of those companies.
Okay. And my last question is, what will be your product portfolio, approximately, estimated portfolio, finished goods portfolio after 1 year or so? We'll be adding some new products definitely. So how will it look like?
We are working on, because if you get a chance to come to our facilities, just see not our facilities, you are an investor of our company and you are a partner of us. You must see that what we are doing and what is our strength, core strength. So I appreciate if any of the investors or anyone who want to visit the facility, we are happy to show them.
Okay. Thank you.
Thank you.
Thank you very much. The next question is from the line of Bhavesh, who is an individual investor. Please go ahead.
Good evening, sir. Congratulations on a good set of numbers. My first question is with respect to your capacity utilization. What is the current capacity utilization, if you can tell us?
So basically, capacity utilization for us is slightly different as compared to our peers in the industry, because I think this question comes up in every earnings call. So how we look at capacity utilization is, you have to understand that one single factory taking care of, let's say, 700, 800 SKUs. So it is not just about the capacity utilization, it is about the number of SKUs that are being handled. So this way, if you look at the product mix that we have and the revenue that a particular plant can generate, so we look at the number of SKUs that the plant can handle. So that way, the new facilities that have come up, that is there for future expansion. But if you talk of the product display segment, so that is a plant that is relatively new also, because we sort of shifted the manufacturing facilities a couple of years back only to that facility. So there we still are, if I talk of percentage, which is not a true, presentation of what I'm trying to explain, but just to make things a little simple, maybe let's say for us the peak is at around 70-75. So in that unit we are maybe at 50-55. So there is still a lot of scope left in that plant, because like I said, it's relatively new. And the ODM division, we are, like I said, we are handling more than 700, 800 odd SKUs. So manufacturing those products in 30 days, these many number of SKUs in itself is, an achievement, I would say. And so that is why for us, if you visit the facility, if you understand what we are doing, because we are not manufacturing products in millions, like maybe a bulb or tube light, which are being manufactured in millions of pieces. So there we can talk of capacity utilization, and it's very clear in terms of how much of it is being utilized. Whereas in our case, it's a little tricky to understand that, and it's something that is sort of evolving as we are growing. So once you come visit and understand what we are doing, so you will understand in a much better way what I'm trying to explain right now. So,
okay, understood. Got it. So coming to your TWS segment, your wearables and wearables. So what is the time taken to onboard a customer, like 1 month, 3 months, 6 months, and your solar panels also?
So I think in that wearable segment, I would say that we've been fortunate enough that we are currently working with 7 to 8, I would say, the top brands in India, the good brands in India who are selling their products in large volumes. And we've been able to onboard them. We started this activity almost 10 months.
2 quarters.
The operation started 2 quarters back, and before that we started some groundwork, to laying the foundation of this particular vertical and all of that. So we've been fortunate that I think the setup that we have created and the kind of business that we are doing, so that is really helping. So once the customer visits, he understands our capability, he understands how we are different to our competition in this category. So these are some of the advantages that we have, and they see what they can do with us in the future. So we are trying to shift this product category to ODM now, which I think wasn't really thought of up until now. So people were relying on the kits from China and just doing the repackaging. So that is the first phase how we have also started the business. But going forward, like I said, we are doing a lot more than that, and probably from the first quarter of next year we will be rolling out products which will be manufactured completely in-house in that sense, the way we are doing in lighting.
Again, but like in this segment also, like previous question, we just tied up with a Honeywell. We got their first approval for their security products. So they are also electronics and hardware, and we have already started getting the purchase orders from them for fire alarm systems, sensors, etc. So it is not lighting, but it is related to all electronics and hardware. So our core strength is electronics and hardware, and that is why the lighting is also one of the part of that.
Understood, sir. So you'll be manufacturing this solar panels and hearables and wearables in this new facility, right?
No, we have a new facility we are going to dedicate to for lighting products as well as Honeywell home security products like their fire alarm systems and sensors.
And there are other non-lighting categories also, including lighting and non-lighting, which we plan to do in the new facility. So we will, continue informing about these new developments as and when we are in that position to, speak about them publicly. Like I said, we started talking about wearables just, I think, maybe a quarter back or a couple of quarters back, but whereas the work had started almost an year back. So once we are in a state to talk about the new developments also, so every quarter we'll keep on adding and updating our investors of the developments that we are doing.
Okay, but your presentation says that you'll be manufacturing solar panel systems in your, apart from your lighting and any other new product line, you'll be manufacturing solar panel systems. So what is the capacity allocated for this solar panel?
Okay, so solar panels, we are giving the solution, like it has a charge controller, it has the assembly feed for recreation vehicles, then it has all the other systems for to install those solar panels. So we are selling the complete system, not only the solar panel, and it is for the specific for recreation vehicles.
So you manufacture, not only, you don't assemble, but you get the cells and then you...
we will not right now going to manufacture.
Sorry, sir? I couldn't hear you.
So basically, we are doing the assembly of these solar panels. The solar cells we don't manufacture. So we are buying those solar cells and creating the product around it, whatever is required then in-house, and then assembling the product. So this is what we are doing in solar panels. And we believe that as this the ESCO RV is one category where we are supplying, but we believe that this category, the ESCO category, once it starts gaining traction, it is already doing well for the time that we have started this vertical. It's very, very new, but it's already doing well, and we believe that going forward in this category, there will be more and more requirement of these kind of products as well.
Great, that was helpful.
It will be required for the expansion that we will do in the lighting and non-lighting products both. So this is being set up in that way.
Perfect. Understood, sir. Thank you so much for the clarification and all the best for your upcoming quarters. Thank you.
Thank you. Thank you, Mr. Bhavesh. Thank you.
Thank you very much. The next question is from the line of Dhiren Khatri, who is an individual investor. Please go ahead.
Sir, good afternoon.
Good afternoon.
In the last quarter, you said that you will be growing at a rate of 20% in respect to last year, right? Till half yearly results, we are growing at 11%. So are you sure that you will be able to achieve your guidance of 20% in respect of revenue as well as PAT and margins?
So in respect to revenue, because a lot of the new product categories are yet to kick in, so they are eventually like this particular quarter, the third quarter where we are right now. So the hearables and wearables, I would say mass production has started in the third quarter now. So second quarter, it was just few initial, maybe trial lots, sample lots, approvals, and all those things were happening. So that is why these new verticals are, every quarter, new and new products will be getting added, and the newer segments which we are talking of, like Mr. Hardeep mentioned about the Honeywell business, the hearable wearable kicking in the third quarter. So these are the things that will add up to the revenue that we are doing till now in the third and the fourth quarter. So that is why initially also in the call, we did mention that we are in line with the projections in terms of the revenue, and if there is any deviation, then probably in the third quarter we will update, but we are in line to what we had projected. And in terms of the revenue, the EBITDA margins, like I said in I think one of the previous questions also, close to around 20%, or in that lower band of what we had projected is what we are targeting.
Okay, thank you.
Thank you so much, Mr. Viren.
Thank you very much. In the interest of time, we will take that as a last question. I now hand the conference over to Mr. Hardeep Singh, Chairman and Managing Director, for closing comments.
So I thank you all who took out the time and being a part of the call and asking the questions. So I'm actually looking forward to the times ahead, the quarters ahead, because we are making a lot of efforts for some new categories and product lines, and we are working towards achieving our goals and targets. And I thank you all for taking out the time, and see you all in the next quarterly call.
Thank you very much, sir. On behalf of Ikio Lighting Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.